Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, it's episode number 70, and we're talking about all things real estate syndicate investing. We have a guest on the podcast this week, Anthony Scandariato from Red Knight Properties, who does real estate syndication and joins us to tell us all about it. Basically, real estate syndication enables a bunch of limited partners to pool their money together and purchase and invest in a larger piece of real estate than they'd otherwise be able to afford on their own. And it's organized and managed and structured by a general partner who's responsible for sourcing the deal and managing properties and eventually exiting down the road. So we had a really insightful conversation. Anthony's been doing this for quite a while. He tells us all about the structure that his firm uses in sourcing these deals, raising investment dollars, and what investors need to know before investing in a deal like this. I hope you enjoy it. Welcome, Anthony, to the show. Thanks for being on with us today.
All right, Grant. Thanks for having me. I really appreciate it.
Yeah, I'm really excited to talk to you. You know, we talk about a lot of investment and financial planning kind of stuff on the podcast, and we have yet to cover real estate in a whole lot of depth. You know, I've given my 2 cents a couple of times on the show about real estate investing and how to evaluate rental properties and, things I see from my seat as a financial planner. But you do this in a whole lot more depth and detail than I do. So I'm really happy to have you on and pick your brain for a little bit.
Excellent. Well, again, I really appreciate you having me on, Grant. It was a pleasure having you on my podcast too. If you want to check out that episode, it's Discovering Multifamily Podcast, and it's episode 131. It was released on March 19th, and we talked a lot about from the planning perspective for actually medical professionals on how they can acquire real estate as an owner-operator to receive many different tax benefits. So that was very interesting. So make sure you guys check that out.
Yeah, we had a good conversation about the benefits of buying or building a commercial building for use for your own business. It's a really handy wealth builder. Why don't we start here, Anthony? Could you tell us a little bit about real estate syndication, what that is, how it's structured, and then I'd like to dive into your outfit, Red Knight Properties, a little bit later on too. But let's start with just how real estate investing works in your world.
Sure, definitely. So real estate investing, there's two ways that I look at it. It's either you're going to invest actively or invest passively. So really defining which avenue you're going to take is key before you even venture and even think about investing in real estate. So what I mean is the active side is finding the property, doing the due diligence, all the inspections, so on and so forth, finding the loan, finding the equity, the down payment to fund your transaction, asset managing, running the deal from basically soup to nuts throughout the investment horizon. And property management, that's really an active participation in real estate. If you don't want to deal with that, and I primarily deal with, and Grant knows, with multifamily, you have the 3 T's, which are toilets, termites, and tenants. So if you don't want to deal with that, you can, invest with a real estate operator / real estate syndicator, which is on the passive side. So you don't need to do any of the things that I just said on the active side, except help fund the transaction. So just in broad view, people put together real estate syndications to leverage financial resources they may not have on their own as an operator. So in my example, typically I work with groups of, usually it's individual investors. When we acquire a $5 million property, it's not something that, I could buy by myself, but I can, participate with a bunch of other people in a group and able to leverage that money to buy larger properties. So that's really what a syndication is. It's just the ability to leverage, usually it's equity for real estate.
Yeah, that seems like one of the biggest benefits from my perspective of going that route. I mean, obviously you have the active passive distinction to where if you don't want to be dealing with the toilets, termites, and tenants yourself, then you hire some kind of property manager for that. But when you pool together your resources with a bunch of other investors, now you're opening the door on accessing an entirely different market. If you're an individual investor and you want to be investing in real estate, you're probably looking at single family homes, buying them, renting them out, maybe duplexes, smaller multifamily units. When you pool together your resources with a lot of people, you're looking at much bigger opportunities, right?
Exactly. Yeah. And so for us, a little bit about my company, our deal sizes, we generally look for, I mentioned 5 million, usually 5 million to 20 million. So we're able to, again, leverage the financial resources of our network. So, and it's much more efficient to do it that way than, like you mentioned, Grant, buying a single family or a duplex, which I also did. That's how I got started. But I can tell you it's a management headache and it's not worth the risk and or money. And you can only scale so far by yourself with 2 families, 3 families, 4 families, anything 4 units and under. Really difficult to amass enough scale in order to achieve financial independence. So, and it takes a lot of time too. So the real estate syndication route is a great way to get to where your financial goals are quicker, as long as you make sure you align yourself with the right operating partner, which is what my company Red Knight focuses on.
So how does this? We've talked a little bit about syndication in general. You're working with a partner who's pooling together the resources of other investors and some on their own. What is the legal structure of this thing? Is this a general partner, limited partner kind of relationship?
Yeah, so the way that we structure it is it depends upon the deal and if we're marketing it or not. But there's SEC, regulations around solicitations for these types of investments. Usually, it's commonly defined as 506B or 506C. 506B are, investments you can present to your immediate network, so you kind of have a trailing relationship with. 506C is, I could post on LinkedIn or Facebook and shout from the rooftops, I have this great deal in Florida. It's 100 units. I'm looking for minimum investment of $50,000. My IRR is going to be 15% over a 5-year period. Here's what the cash flow distributions look like. Not allowed to do that with the 506P. You could do that with the 506P, but I can't post that on social media and use some advertising dollars. So those are the two for real estate syndications. There's some other ones too that I don't have exposure to, so I'm not as well versed in it. But the 506B and C is what I'm versed in.
Got it. So you're structuring these pursuant to those two rules. You have marketing limitations as a result of that, and then when people buy into these opportunities as deals come across your desk, they're limited partners, meaning that their risk is not financial risk, but legal liability is limited, whereas you as the operator are taking that on as the general partner in the deal, right?
Exactly. So we're signing. So the general partner really, is responsible for making sure the deal performs as an investment, but they also take on the risk. So, you have to, in some cases, as a general partner, guarantee the loan. Basically personally guarantee the loan or sign what they call bad boy carve outs, which you can get a loan that's non-recourse, but it's depends upon, they can make it recourse. They can figure out a way if you default. So the general partner does take on all the liability risk. So let's say a tenant slips and falls and there's a large insurance claim. The general partner is responsible for remediating that. So there's really, nobody even knows who limited partners are generally in a deal. But, like for me, using me as an example, I'm one of the faces of Red Knight Properties that would be responsible for those types of things. But the way that It's structured to avoid, the limited partner you mentioned's liability. Is we have it's called a private placement memorandum, and for each deal that we present to our group, they sign a subscription agreement, and they sign off on an operating agreement, which basically entitles them to the amount of units that they own in the property and the amount of liability that they really don't have on the deal, except the financial risk of your initial capital contribution, which is always risks in investing. So
Right.
that's generally what we provide.
Got it. So how do you, can you walk me through the life cycle of one of these things? Are you coming across these you're out there looking for these opportunities to, buy, rehab, and then maybe exit into these larger properties. And I'd love for you to share about that process a little bit later. But in general, are you finding these opportunities and then putting together deals and soliciting investment dollars after that? Or are you working with investors kind of blindly first and then trying to figure out where to put the money afterward?
No, so we don't have a fund that's set up. It's usually on a deal by deal basis, but we do have, and our network is expanding pretty much each and every day of, interested investors that would participate in the next deal. So it is on a deal by deal basis. I think a fund level would be for, someone that has maybe a 20-year track record under their belt that's able to do that. I could be wrong too. A lot of young companies starting funds. So what do I know? But we've been very methodical about it every time we do a capital raise. So what generally happens is we'll get awarded a deal. We'll sign the contract, but even prior to signing the contract, I'll put together the PPM ready to send out to our investors while we're under contract, so we can avoid any issues. Usually the contracts are, I call it 90 days or so. So generally we're looking to fulfill the capital contribution within a month, give or take. That's generally what happens. So that's sort of time frame wise how it would work for a syndication.
How much of a commitment do you have to make as the general partner when you find something that you want to buy? Are you out of pocket? Are you buying it first and then finding investors, or hoping you can find investors in it? I mean, how do those two things intertwine?
Yeah, so the SEC, they have rules around that as well. I believe it's if you acquire it, you have up to a year to sell off shares in the 506B and 506C model. We don't do that. We generally, raise all the money up front, and we've been pretty fortunate to be able to do so. Like I mentioned, we want to avoid, pretty much any of that. We want to make sure, we raise money for the down payment, the closing costs, the capital improvement dollars. So we're in a good position to, take over the property right away and start executing on the business plan. So generally the deals are, they're funded up front. We've never been in a situation where we've had to fund it ourselves. The risk also that we're taking, Grant, another general partner risk, is there's a lot of deposits that go into real estate. So when we usually sign a purchase contract, us as the general partner, let's say, it's a $5 million building. I'm actually working on this right now. $5 million building. They want, a good faith deposit, which basically is earnest money. So if you don't close on the deal after your due diligence period, then you don't get your money back. So that's like $100,000 right there. So there's a lot of risk that the general partners take that the limited partners don't. So, but it's all relative. So I'm also a limited partner myself in some other deals, and it really depends upon what your goals are. So it's kind of interesting to see both sides.
Sure. So these things, so these are all leveraged, right? You're obtaining loans from banks to go close on these deals. What
Yes.
are the typical terms of a loan you're seeing these days?
Yeah, it depends on the deal. So you mentioned renovation. So we're in the value add space. So generally what that means is what I focus on is called workforce housing. So we're generally buying class C, maybe C plus, and then we try to turn it into, we'll try to turn a C into a B minus, or C plus into a B. So we're always trying to upgrade the, aesthetics of the property. So usually that requires capital improvements. Sometimes we'll get a loan that will fund those capital improvement dollars. If it's a big, renovation, like I mentioned before, usually we'll raise money for the capital improvements for the down payment if it's not too much, and it's just a management play. So the terms for lenders are very, very different. Also depends what type of loan you're going to be receiving. But anyway, just a general rule of thumb, it's anywhere from 65 to 75% leveraged. But again, it depends if you go through a bank or through a government, backed agency like Fannie Mae, Freddie Mac. Bridge lending could be up to 80% in some cases, a little rarer nowadays, kind of coming out of COVID. But all different types of lending, we try to cater the best towards the business plan.
That makes sense. So I didn't realize Fannie and Freddie supported transactions like this. I thought they were exclusively single-family homes. That's not the case, huh?
No, they actually are one of the largest, multifamily lenders, particularly in 2020 when a lot of the bridge markets shut down, a lot of the warehouse lines from those lenders dried up. No one really knew what was happening in the world. So, but the agencies, Fannie Mac and Freddie Mac and Fannie Mae, were the only players in town for basically all of 2020. And they had, now they have, what's really interesting is affordable housing mandates for their lending portfolio. So they're even more aggressive, at least from what I've seen in 2021 on getting the money out there. So they're very, especially with multifamily, they're probably the top lender for 2020.
Interesting. So take us through a typical timeline for one of these deals. What does your process look like? How do you source these deals, and what happens next?
Yeah, no, definitely. So when we source a deal, like I mentioned, we're usually working through our network, through brokers. Typically, they're off-market relationships, just through real estate agents that we know and we developed a relationship with. We don't like to get in the bidding wars because it's a whole different ball game, and it's tough, and we don't want to overpay for properties. So we try to get some quiet opportunities. So we'll find the opportunity, underwrite it. If it makes sense, we'll put in an offer. And if the offer is accepted, then we'll go to a purchase contract. So 14 days after the initial offer is accepted. And then that's when I talked about, putting the PPM together. And as soon as that signature is signed, we'll get it out to our investment
PPM
network.
stands for what?
What's that?
And PPM is an acronym for what?
Private placement memorandum. So basically it's the, investment summary is what we like to call it, which outlines all the risks and disclosures, the business plan. But basically from there, like I mentioned, it usually takes, let's say, 90 days to close after we get the deal under contract. Then we'll start, executing on the business plan. If it's a value add deal, we usually underwrite opportunities over a 5-year investment horizon. But really depends upon the deal. What we try to do is add as much value as we can, as quickly as we can, so we can turn the building around, whether it's through expense reduction or revenue, increasing revenue through, rent raises, and et cetera. Ideally, you want both. And then we turn around and go to another lender and say, hey, here's my new net operating income. It went from $300,000 to $600,000 in, let's say, 24 months. I want to do a cash out refi. So we've done that a few times where we've been able to basically return everybody's capital within, 15 months. A couple of examples I've did, plus profit on top of that. And now we own the building pretty much with zero risk anymore, except some, management risk moving forward, which is really minimal. So that's generally what we like to do. We like to look for deals that are income producing, multifamily, that have value add, where we have the ability to, really turn the asset around, create a liquidity event, a tax efficient liquidity event for ourselves and our investors, and then continue to grow our portfolio together.
So I see. So you find the opportunity, get in. You're trying to boost revenues and decrease your costs simultaneously. And one of the nice or convenient levers in terms of cost reduction is doing a cash out refi a year or two after coming in, purchasing, rehabbing the property a little bit, which is it's pretty convenient to be in an environment where interest rates are falling, I suspect, alongside that, right? So you take cash out, you have a much leaner expense profile in the property, which reduces your risk. You can return some of that cash to investors, and then what happens after that? And I'm curious about the process of raising rents on your tenants too.
Sure. So it really depends. So after the cash out refi, typically we hold the buildings. So we are always checking the status of the market, and if it does make sense to sell, or if it makes sense to sell, we'll try to do a 1031 exchange. So there's a lot of complicated outside factors, but the general rule of thumb for us is if we don't refi the property and return at least 100% of capital within that 5-year period, then we're going to sell, because we have a fiduciary to return capital at some point. So we can be a little flexible once we return that capital. So we could, in theory, we can hold, if it is a 15-month cash out, usually we get a long-term loan after that. Usually, let's say it's a 10-year loan or a 5-year loan with a 5-year option. So, we can hold it long-term as long as everybody's okay with that. And for the most part, they are, as long as they got their initial money back. And then they just have this like annuity moving forward that just keeps, generating them cash without even having to really worry about it. So that's generally how it works. In terms of raising rents, it's a touchy subject, but the way that we do it is we don't just go in and raise rents a couple $100 or a few $100 just for the heck of it. We go and raise the rent. We check what the market comps are in the area. We check kind of, what kind of employers are coming in and what's the trajectory of the rents moving forward. And what we'll do is, if there is a month-to-month tenant where we take over a building, we'll usually offer a few options for their new lease. And obviously, some of the tenants, they see the big increase and they leave, and maybe they weren't a great tenant in the first place, but they are good tenants that, have the ability to afford more. But we do make improvements to their units. So what we like to do is we like to see every single unit before we close, and we'll internally, as the operators, write down, okay, it looks like this one needs a new countertop. It looks like unit 20 needs a new kitchen backsplash. We'll actually make recommendations, because sometimes the tenants won't really know what they want. So sometimes they do, and we've been fortunate for some people, like, it would be great if you can replace my toilet. Like, okay, yeah, that's it. No problem. We're happy to do that. New management in town, but here's the rent increase, and they're happy with it. So we get a little creative with that, but we're very specific. So we, specific to their unit, and then we'll also do a 1-pager of what type of exterior, because we're usually doing exterior improvements, of what type of exterior improvements are going to be made. Is there going to be a new dog park? Is there going to be a new monument sign? Is there going to be, a new gazebo? Like, all sorts of outdoor amenities that we'll say that we're doing to improve the community, along with the rent increase. So that's how we're able to get them to minimize turnover, because not every tenant will stay. People just want the cheapest place to live sometime. But for the most part, the good ones will appreciate it, what we're doing.
Sure. So if you're working with like a 5-year return of capital horizon just on most of these deals, and I suspect that you're creating these business plans and going out there and raising capital with that intention communicated through the private placement memorandum and all your other documents that are communicating to investors what they're getting themselves into. So if you have a deal where you're able to do a cash out refi, and between that and the operating income, return a bunch of cash to investors to where they've gotten most of their money back, it seems logical to me that most of the investors would be comfortable maintaining their subscription in the deal. Like if you were to 1031 exchange, sell the property, and then keep or reinvest the cash, what is it, within 45 days, right? In a new property, the investors would be comfortable maintaining their status as a subscriber and limited partner in the deal. But how is that decision made? Because if you have 50% of your subscribing capital that wants to cash out and the other 50% wants to stay in, that seems like a cash flow challenge from your perspective, right?
Yeah. So on the sales side, we haven't had any challenges with anyone yet. On the refi side, we also haven't had any challenges. Typically, if we're going to do a cash out refi, we're going to do it and find another property to give everyone the option to invest in that property as well. And 90% of the time they will, as long as you're performing. So we give that optionality, and I mean that's pretty much it. We haven't had issues with the situation that you've described. There are some ways to mitigate those issues if they do come up, but for the most part, we're generally looking to grow together in more of a longer term relationship. So yeah, so you could definitely get cashed out, especially with the refi, and do whatever you want with the money, and you'll still have an interest in the deal. It's not really a cash out of the deal. That's a little bit different than some other operators. Some operators, let's say, they just offer a preferred return of 8%, and they cap it at 8%. So our company, we share the upside with the limited partners as well. So if we hit, for example, over a 15% IRR, then there's a profit share after that. Let's say it's 50% us, 50% to the limited partners. So they're not capped. They're not out of the deal. So let's say we return the capital. Most likely you're going to hit that 15% IRR at that point if you paid your preferred returns and you paid some, you have some profit on the cash out. Most likely you're going to hit that. So after that, it goes into another hurdle, but that also means that the limited partners still have an interest in the property. So it's not like they're getting completely out of it. Yes, they're getting their money back. Yes, they're getting, their if there's any profit on the refi proceeds, but they're still in the deal. So they're still generating cash flow.
Sure. That makes sense. And I guess if they did want out, you could always replace them with new investors too.
Yes, if they did want a completely out, yes. We have provisions actually in our subscription agreement to allow for buyouts, so we can buy them out. They could come to us and we could buy them out. It depends upon how big the investment is, but
I see. What are your thoughts on the 1031 exchange in general right now? Because there's a lot of talk about Biden's tax plan, and he's been pretty forthcoming with his distaste for the 1031 exchange and the tax code in general. What have you been following that at all? What are your thoughts?
Yeah, I think it's without getting political, I think it's a little bit of a misunderstanding of what the 1031 is really used for. I wouldn't, say it's a tax loophole, because it's not. It's really you're reinvesting in communities. You're reinvesting the money in, you can take all the money off the table and pocket it and go to Bermuda, or you can, do it's tax deferral. So you do eventually pay taxes and exchange it into another like-kind piece of real estate where you can also improve, you can also add value to. So it's, there's a lot of different, factors that I think if that does go away, and to be honest, I don't think it's going to go away. There might be some modifications. But if it does, the state and local municipalities really will get hit hard because, as I'm sure you're aware, there's transaction volume will just go down. So the tax revenue from transfer taxes and mansion taxes and all that, recording fees, deed fees, it's, the title industry and, the state and local municipalities. I think that'll be the big one for them to really take a look at. Will lose revenue. And there's so many studies that the 1031 actually is positive for, if they got rid of it, there's a few studies that that basically say that I think it was over a period of time, but it was a loss in tax revenue of like, I don't know, it was definitely in the billions. But it's personally, I don't think it's a good idea to repeal it. Knowing what we have up ahead of us, there's a fair shot that it does stay in place, but may be modified. And I haven't heard him talk about it since this campaign.
I follow this stuff a little bit. Anytime there's a change in the tax code, there are planning opportunities around it, either getting in front of it or doing something strategic with a new tax code in place. That said, there's a lot of noise that come from legislators that never becomes law. And so I kind of put my ear to the ground during the election cycles, but I try not to read drafts of bills. I only try to read them and stay up to date on them after they're passed. And I don't have any idea whether it'll be maintained or modified or eliminated entirely. But it's an interesting cycle because there's definitely going to be some tax changes here in the next 18 months, probably.
That's true. And so, if there is a tax change, so if it is repealed, great thing about the real estate industry is that we adapt very quickly to the changes, and there'll be something else. And there already is something else. Deferred sales trust is another option, which you basically selling the asset to a trust as a seller, and the buyer is buying the asset. So that's a way to defer taxes too as a seller. So there's already mechanisms that are in place in lieu of the 1031 exchange. That's a little bit more. I wouldn't say it's more complicated. Actually, it's actually kind of interesting. I've never personally done one, but I've been hearing a lot about it. So there's other vehicles that'll just pop out. Because the tax changes do, like you mentioned, tax changes happen pretty much every election cycle. So, or every 4 to 8 years. So you have to stay on top of it.
That's right. Creates a lot of business for me. Selfishly.
I'm sure.
What about how does a rising interest rate environment impact the economics for you?
Yeah, so if you're talking about rising rates, it's all everybody. I haven't seen. I think the Fed is supposed to speak tomorrow, and they're going to make a statement. Who knows? From what I understand, the rates are going to be low until the end of 2022 at a minimum. I know that the 10-year Treasury has pretty much doubled since the early 2020, which is a little scary / crazy. That just means inflation is coming our way. The government did just print $2 trillion. So who do you think is going to pay for that? So inflation is coming our way. That will mean higher prices of, a lot of consumer goods and food and gas and everything. So I think that, inflation is for real estate's actually a good thing. I wouldn't say it's a good thing for the broader economy, but for real estate, it's good because it's a hedge against inflation. Because as the value of the U.S. dollar, gets lower, the asset is of particular real estate stays the same or even gets a little bit more attractive because there's, it's always been a hedge against inflation. So that's another reason why I like the asset class.
Yeah. I think I'd probably push back on you a little bit, respectfully, of course, on just jumping to the conclusion that we will see inflation from all these dollar printings. It's a big concern of mine too.
Sure.
And I like holding real estate as an inflation hedge as well, and it's certainly not a perfectly correlated asset to U.S. dollar values and core CPI and all this other stuff. I'm just not convinced that we're necessarily going to see massive price increases based on the fact that we have the exorbitant privilege of being the world's reserve currency. And even though we're printing a whole lot more of it, US dollars are still used to effect transactions all around the world. Everybody still wants to use US dollars, and that appetite, I mean, we're really pushing the envelope on, testing the rest of the world's appetite for US dollars, but it hasn't gone away yet. I personally wish we would be a little bit more responsible with our spending too.
Sure.
But I mean, regardless, real estate is definitely a help against that kind of risk. I just don't know that we are necessarily going to see inflation, but it's certainly a fear that the market has right now, based on what we've seen in the 10-year Treasury yield jumping last 6 or 8 weeks, and to your point, doubling over a little bit longer period than that. So people are definitely freaked out about it. I mean, whether that comes to fruition or not, I don't know.
Yeah, no one has a crystal ball. We'll see what happens. I know a lot of at least the $2 trillion has not been dispersed yet to a lot of states. So sure, they're just printing the money right now. But the other thing that's concerning is the U.S. debt, how much debt the country's accumulated. So, and it's just kind of adding to that, and who's going to be the ultimate bill payer at the end of the day in 30 years from now. So that's right. That's a whole different discussion, but I tend to agree with you as well.
Yeah. No, you're right. It's a huge concern. So what else? What have we missed, my friend?
I think we covered a lot. I hope I was able to share value to you and your listeners. Any real estate related question, feel free to reach out to me. Pretty easy to reach. LinkedIn, Facebook, Twitter, Instagram, you name it. You can check out company's website, Red Knight Properties, Red Knight with the K. And if you go on, you can actually we have a free ebook. It's how to leave your 9 to 5 through real estate investing, which I was able to do a couple of years ago. So, which I wrote. So if you actually, all I need is your name and email. I'll send you a free copy, and then you can even follow up with me that way as well.
Cool. What's the name of your podcast?
Discovering Multifamily.
Discovering Multifamily?
Yep. You can find that on iTunes, Spotify, Stitcher, you name it.
Right on. Well, thanks for coming on. This was really insightful. I appreciate you sharing some of your wisdom and experience. This is really cool.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.